developed a basic trend following system when I started trading options 30 years ago, and I'm still using that trend following system today as part of my high accuracy option trading. So this program has a long history of profitability. So today we're going to take a look at the high accuracy option trading program. I also have some trades that you can take tomorrow, and then at the end I'd like to have a Q&A session to answer any questions you may have. So just in the way of background, I started my options trading career 30 years ago, and as I mentioned, I developed a basic trend following system that I still use today. And when I started out, I only had $4,600, so that's all I could put into my trading account at the time. But within my first 2 years, my tax return showed that I made over $460,000 in profits, starting with that small account. And that was more than I made the previous 6 years as an airline pilot. And the option strategies have produced over $6 million in actual profits over the years. And here's a copy of those tax returns those first 2 years showing that $460,000 in profit. And I won the World Trading Championship 7 times, and that's a real money trading contest, and the results are audited before being posted on the sponsor's website. And year to date I have 140% real-time return, and that's putting me in second place so far this year. And my brokerage account statements I'm going to show you today show that I have over $3 million in profits using this high accuracy option trading strategy. So the strategies, as I said, have a long history of profitability, and I'm giving you this background information. I'm not trying to brag, but I just want to let you know that the history behind this strategy that we're going to look at today. So part one of the high accuracy option trading is the trade selection process, and there's 3 steps in the trade selection process. Step 1 is we want to determine the price trend of a stock using the 50 and 100-day exponential moving averages. And then step 2 is we want to confirm that price trend using on-balance volume and the new 52-week high list to isolate the very best trading opportunities. And then step 3, a very important step, we want to select a low-risk entry point using the Keltner channels. And then part 2 of the high accuracy option trading is the trade management. And I use what I call the 1% rule to select an option strike price with a high probability of success. Step 2 is we use the 30% rule for walking away. And step 3 is at rollover, we want to roll over the option if the stock is still on a prime trade select buy signal and the trade is profitable. So we generally roll over the options if we have a profit and it's still on a buy signal. And I currently have over $1.2 million in open trade profits in my 2 retirement accounts with an average return of 174% using the high accuracy option trading and the techniques that we're going to discuss today. So I'll show you those account statements. So let's start out by talking about the general risk involved with trading options. And as you know, options are leveraged and they provide more profit potential compared to stock investing, but with that leverage you also incur more risk. So this is a snapshot of a Home Depot option chain, and at the time Home Depot stock was trading at 77.73. So you can see the at the money call at that time would have been the 77.5 call, and with 67 days to expiration, this at the money call was trading at 320 bid, 330 ask. So what I did is I plugged in the current stock price for Home Depot, which was $77.73, the option strike price of $77.50, and the premium of $325. And then I click calculate, and the call option purchase calculator will calculate the profit potential for this trade, assuming various price changes in Home Depot stock at option expiration, in this example from a 10% increase in the stock price to $85.50 to a 20% decline in the option price to $62.18. So this, the bottom row here gives you the percent return potential for this trade, assuming these various price changes in Home Depot stock. And you can see that if the stock remains flat at option expiration, you'll have a 92% loss. And then if the stock is down at all, you'll have a 100% loss. So this just illustrates the risk involved with options, and anytime you buy an option, you're risking 100% of your capital or the price that you paid for that premium. So the goal of the high accuracy option trading is not to incur these large losses. And of course, if you have a 50% loss in your portfolio, it would take a 100% gain just to get back to break even. So we want to avoid these large losses that you can incur in trading options. And as it turned out, Home Depot did close at 75.38, and this would have developed into a 100% loss on this trade. Okay, so again, we want to avoid these large losses which can knock you out of the game. And I'm displaying a daily price chart for the VIX, which is the fear index, and these vertical bars are the daily price movement of the VIX. And you can see that each one of these spikes up represents a market sell-off. So you can see if you entered an option trade and you had bad timing and you hit any of these sell-offs, it could result in a 100% loss. So we're going to talk about ways that you can mitigate that risk. And if a stock is on a prime trade select buy signal, we want to purchase call options. And if a stock is on a prime trade select sell signal, we want to purchase put options. And prime trade select works in both bull and bear markets and was very profitable during the last two bear markets. We were heavily short in the 2008 and the 2002 bear markets, and we had all short positions at the time, and we were able to profit on the short side using the basic trend following system. Okay, so step one of prime trade select is we want to determine the price trend, and we use a trend following system to determine that price trend. And the goal of a trend following system is to quantitatively measure the buying and selling pressure of a stock, and that allows us to follow the trend instead of trying to predict the trend. And I like to use a system instead of using emotional decision making. And as I mentioned, I've used this trend following system successfully for many years. And I use the 50-day and 100-day exponential moving average to determine the trend. When the 50-day exponential moving average is above the 100-day, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. So let's take a look at an option trade that I took using Prime Trade Select. And this was for Cigna, the insurance company. And here's a price graph, daily price graph of Cigna. And again, these vertical red and black lines represent the daily price movement of Cigna stock. And we can see in September, the blue line, which is the 50-day exponential moving average, crossed above the 100-day exponential moving average. And at that point, Cigna was on a buy signal. And then we can see that the 50-day EMA stayed above the 100-day EMA. So as long as the 50-day is above the 100-day EMA, that stock is on a buy signal. So on any given day, there can be hundreds of stocks that are in a buy signal. So what we like to do is narrow down that list of stocks with the best profit potential, and we use two trend confirmation indicators, one of which is on-balance volume. And on-balance volume measures the volume flow with a single easy-to-use line. And the volume flow precedes price movement and helps sustain the price trend. So I like to take a look at this volume flow to see how sustainable the price trend is. And you can download the on-balance volume for the at stockcharts.com, and I just use the default parameters when I'm bringing up this on-balance volume line. And the way the line is calculated is when a stock closes up, volume is added to the line, and when a stock closes down, volume is subtracted from the line, and a cumulative total of these additions and subtractions form the OBV line. And here's that daily price chart again of Cigna stock, and the chart below here is this line right here is the on-balance volume line. So we're not concerned about the numerical value of that on-balance volume line. We simply want to see that line moving up. And if that line is sloping up, that confirms the price uptrend. And another trend confirmation indicator we like to use is the new 52-week high list. And stocks that are making a new 52-week high are in a very powerful uptrend. And in my trading experience, I found that these stocks that are making a new 52-week high on a regular basis tend to continue their price uptrend. And if a stock is making a new 52-week high, then again, that confirms the price uptrend, and that allows us to further narrow down that list of stocks to buy. As a matter of fact, the new 52-week high list is a great place to start your trade selection. You just look on that list and you'll see that there's a series of stocks that continue to show up on that new 52-week high list, and those are the stocks you should be focusing on. Here's that daily price chart again of Cigna, and we can see that Cigna was making a series of new 52-week highs in a very strong uptrend, confirmed by the upsloping on-balance volume line. Okay, and step 3 of our trade selection is selecting a low-risk entry point using the Keltner channels. And the Keltner channels are very useful, and they can be used to help time your trade entry and exit, and they also provide high probability buy and sell signals. They can also be used to help select option strike prices, and they also allow you to select stocks that have a repetitive and predictive price pattern as opposed to a stock that has no clear price pattern. And I'll show you examples of that. Here's a daily price chart. This is for Home Depot, and this upper blue line right here is the upper Keltner channel, and the dotted line in the middle here is the middle Keltner channel, and the lower line here is the lower Keltner channel. and the Keltner channels are similar to the Bollinger Bands, and they work as an overbought, oversold indicator, and are very useful when you're trying to find a low-risk entry point. So the goal is, when you're trying to time your entry, is you want to buy a stock or an option, or buy a stock or a call option when the price drops near the middle or lower Keltner channel, and you don't want to buy when the stock is trading up near the upper Keltner channel. So here's the daily price chart again of Home Depot stock, and we can see when the stock is trading up near the upper Keltner channel, it's getting overbought, and then it'll usually retrace back to the middle or lower Keltner channel. And so we don't want to buy when the stock is overbought. We want to wait for that retracement, and you can see that Home Depot stock got overbought right here. It was actually above the upper channel, so it retraced back to the middle channel, overbought, retraced back to the lower channel, and we want to buy the stock when it's trading at that middle or lower channels. And we can see when the stock gets oversold, there's usually a rally. So overbought, retraces, oversold, there's a rally, overbought, retraces, oversold, a rally. So you can see that if you try to time your entry for when the stock is oversold, rather than buying it when it's overbought, you'll have a much higher probability of success. So let's look at some examples. Here's Cigna again, the daily price movement of Cigna, and you can see from this price chart that Cigna has had a very large move. It's in this time frame, it went from 50 to 76, so that's more than a 50% move. So the question is, when a stock has had this much of a move, how do you jump into it if you want to participate in this uptrend, and how do you get a lower risk entry after the stock has already made a big move? So that's why we use these Keltner channels, because they can help you do that. And we can see right here, this was beginning of June, the price of Cigna dropped towards this lower Keltner channel, and the stock was becoming oversold. So on June 3rd, I bought the Cigna 50 strike call. So right in here, when the stock price was near the lower channel, I went ahead and bought a 50 strike call for Cigna. Here's another example. This is for Caterpillar, and again we can see that Caterpillar has already made a large move. So the question is, if you want to participate in this, at what point do you jump in and buy a call option? So I had been following Caterpillar. It was making a series of new 52-week highs. The unbalanced volume line was sloping up, so I waited till this time frame right here when the stock retraced towards the lower channel, and I went ahead and bought the Caterpillar 70 strike call. Here's another example. This is for Wells Fargo. Again, I waited. The stock is in a strong price uptrend, confirmed by the unbalanced volume line, and I waited till it retraced, and then got towards the lower channel and got a little bit oversold there, and then I went ahead and bought the 35 strike call. Here's one more example. This is for the ProShares, the Ultra S&P 500 index, and again, I wanted to establish a position, so I waited till the price of the SSO dropped towards that lower channel. Then I went ahead and bought the 65 strike call. So what all these examples have in common is by using the Keltner channels, I was able to get a low-risk entry point, and the stock or ETF did not really retrace much after my buy point. So the Keltner channels allowed me to get a low-risk entry. And when you get a low-risk entry, of course, that can help you prevent getting stopped out of your position, and it helps your timing, and you want to try to avoid bad timing, and just when the stock is getting overbought, you don't want to buy, obviously, and because then you'll have a higher chance of getting stopped out of your position. So we want to use these Keltner channels, get a low risk entry, and hopefully the stock doesn't retrace much from your entry. And here's some examples of Keltner channels for stocks that have very repetitive and predictive price patterns versus stocks that have no clear trend. And in this first example, this is a daily price chart here for Marriott, and you can see that the price pattern of this stock is very repetitive, very predictable, and this is the type of stock you want to be trading, as opposed to the lower chart here. This is for Vale. This is the Brazilian iron ore mining company, and we can see with Vale there's really no clear trend here, so you want to avoid stocks like that and focus on stocks like Marriott that are very repetitive and predictive price patterns. Here's another example. This is for Cheniere Energy, and again we can see very repetitive price pattern for Cheniere Energy as opposed to Peabody Energy, which has real no clear trend. So we like to focus on these types of stocks that have predictive price patterns. Here's one more example. This is for United Rentals, and again a very predictive price pattern versus Mosaic, the fertilizer stock, that would be really hard to trade because it really doesn't have a clear trend. So that's another useful tool when we use these Keltner channels. I noticed there's a few stocks that are setting up for a buy signal. One of them is Apple. We can see it's been making a series of new 52-week highs, and it just retraced down towards that middle Keltner channel. So that's one you want to look at. Facebook is also retraced towards that middle Keltner channel. You want to take a look at buying a call option on Facebook. And here's one more. This is for Equinix. This is the company that owns the servers for cloud computing, and we can see that's also in a strong uptrend and just retrace recently towards that middle Keltner channel. So there are some stocks for you to look at. Let's look now at part 2 of the high accuracy option trading program, and that's the trade management. And we want to use, once we select a stock or an ETF that we want to buy a call option, I use what I call the 1% rule to select that option strike price. We also have a money management rule for a money management stop at 30%, and then we also roll over that option at expiration if we have a profit and the stock is still on a buy signal. So let's look at examples of these 3 rules. The first one is the 1% rule to select an option strike price. So once you select a stock or an ETF that you want to trade a call option on, depending on the stock, there could be hundreds or even thousands of different strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. And let's go back to option basics for a second. Option premiums consist of time value and intrinsic value, and options they lose all their time value at expiration. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind whenever you're buying a call, that the time value portion of that call is decaying every day until you get to expiration, and then the time value is zero. So you always want to keep that in mind. So due to the time decay characteristics of options, when you buy an option, you want to minimize the time value because that's going to decay to zero, and maximize the intrinsic value. So what I like to do is limit the time value portion of an option to less than 1% of the stock price per month to minimize time value and maximize intrinsic value. So let's look at an example of that. So if you purchase a 1-month option and the stock is trading at 100, you want to limit the time value portion of that option to 1 point or less. So 1 point would be 1% of 100 over a 1-month period. And if you were going to purchase a 2-month option and the stock was trading at 100, then you want to limit the time value portion of that option to 2 points or less, which would be 1% of 100 per month. So it's limit the time value of the option to 1% of the stock price. And here's why we do that. If you limit the time value to 1% of the stock price, the stock only has to increase 1% in order for the trade to break even and for you to start making money. So if you purchase an option and the underlying stock only has to go up 1% and then you start making money, you're going to have a much higher probability of success than if you buy an option strike price that requires, let's say, a 6 to 10% increase in the price of the stock to break even. You know, may never happen, and you would incur a 100% loss. So let's look first an example of out of the money call purchase, and I don't have any real-time examples for you because I don't buy out of the money options. I only buy in the money, so I have to use an option chain to as an example for an out of the money call purchase. And this is an option chain for Priceline.com, and at the time Priceline was trading at 1162, and what I'd like to do is look at the 1270 strike price for Priceline. So if the stock is trading at 1162, the 1270 strike price would be considered an out of the money call, as the strike price is higher than the stock price. So let's look at how we calculate the break-even point. If we take the strike price of 1270 and we add the premium of 1260 to that strike price, we come up with a break-even price of 1282. So the stock has to increase from 1162 to 1282 in order for this trade to break even and start making money. So that's a 120-point move in order to break even on this trade, and that translates to a 10.3% increase in the price of the stock just to break even on this trade. So many times you're not going to get a 10% move in the underlying stock, and if you don't, then you're subject to a 100% loss of your premium. So that's why it's so important to focus on these strike prices. So let's look at the call option purchase calculator, and that'll give us the profit loss potential for this out of the money option. Again, Priceline trading at the stock was trading 1162. It was the 1270 option strike, and the premium was 1260. And we can see that again, this will calculate the profit potential assuming various price changes in Priceline stock at option expiration. In this example, from a 15% increase to a 15% decline. And we can see that if the price line is flat at option expiration, we're going to have 100% loss. If it goes down at all, we're going to have 100% loss. Even if it goes up 5%, we're going to have a 100% loss. So you can see the odds are really stacked against you with these out-of-the-money calls. And even if the stock goes up 10%, you're still going to have a 31% loss. So this just illustrates the risk you take with these out-of-the-money options. So let's look at an example of an in-the-money call purchase. And we saw previously Cigna became oversold. So on June 3rd, I bought the 50 strike call at 17. And at the time, Cigna stock was trading at 66.71. So if the strike price of 50 is less than the stock price of 66.71, that would be considered an in-the-money strike. And let's take a look at the risk profile for this. So with, again, with Cigna trading at 66.71, purchased the 50 strike call, I paid 17 points even for it. We can see that, and this call option purchase calculator also calculates the time value and the intrinsic value. So the time value of this option was 29 cents and the intrinsic value was 16.71. So it was mostly intrinsic value. So here's where this is really important. In this example, in this actual trade that I took, Cigna stock, that only has to increase 29 cents or 0.4% in order for this trade to break even and start making money. And we can see that even if you buy these in-the-money calls, if the stock's up 10%, I'll get a 37% return. If the stock's up 20%, I get a 76% return. So these in-the-money calls are have a lot less leverage. And again, with this actual trade that I took, Cigna only had increased 29 cents and I start making money. So as it turned out, Cigna did close at 77.84 at expiration. So I had an actual return on this trade of 63%. So you can do well with these in-the-money calls, even though they're more expensive and they have less leverage, you can still realize a good return with these. So with Cigna, the underlying stock only had to increase 0.4%, and I would break even on that trade and start making money, versus the Priceline example that required a 10.3% move in order for the trade to break even. So we can see that the Cigna obviously has a much higher probability of success. Okay, let's look at our second trade management rule, and that's the 30% rule for walking away. And if you purchase a call option and that value, that call option drops 20% below your entry price, then you want to start looking to exit that trade before it hits 30%. And if you do that, that'll help prevent a 100% loss of your premium. So again, you don't want to incur these large losses when you're trading call options, because you could have bad timing, and if you have bad timing, then you could easily incur a 100% loss. So we use a simple money management rule of exiting an option if we have a 30% loss in that option premium. And again, that's from the your entry price. So here's an actual example. In July, I bought the J&J 80 strike call at 23.72. So what I like to do is each day I'll monitor the prices of my options, and in this example, if the price of that 80 strike call drops 20% to around 19, I'd make a mental note to exit that trade if the option price drops 30%, and in this example that would be at around 1650. So you make a mental note if this drops to 19, and then you want to exit if it drops 30% to around 1650 on a closing basis. So what this does, this money management, is it saves you from potential big losses. Okay, now our last rule here is we want to roll over profitable options. So if a stock is still on a prime trade select buy signal at expiration and the trade is profitable, then I normally will roll over at expiration. And when you roll over options, that reduces your risk for the new option and allows you to compound your returns, and then you can start playing with the house's money. So this rollover is the last step, of course, in the trade management, and we want to make sure that the option is profitable at expiration. If it's not profitable, then we won't roll it over, because if it's not profitable, that's telling you that the trade's not working out. So I'd like to have that confirmation, and I will only roll over if the option is profitable at expiration. So let's look at some examples of this. This is my brokerage account. This is the closed out profit loss report, and we can see that I closed out a Google 950 call, and I had a gain of $7,670. And then these other 5 closeouts, these were all for the XLV, which is the healthcare ETF, and I closed out a total of 36 options. These were done in increments here, but I had a total of 36 contracts for the XLV, and this shows my gain in this column for the XLV and the Google trade. So these trades were profitable at expiration, and both Google and XLV were still on a prime trade select buy signal, so I went ahead and rolled over these options. And you can see with the XLV, I closed out 36 of the XLV calls, and I had a $31,000 net profit. So these closeouts right here total $31,500. Then I went ahead and I purchased 36 of the September 45 strike calls at $15.69. So the cost of the September options was $56,500. My profit on the rollover was $31,500. So that reduced my cost basis to $25,000. So I reduced my risk by more than 50%, and that allowed me to compound my returns with this option trade. So the rollover is a part of the trade management, and if the trade is profitable and it's still on a buy signal, then I normally will roll over those profits, and that reduces the cost and the risk of the new option and allows you to compound your returns. Here's an example. This is the Google rollover. You saw where I had a $7,670 profit. Then I went ahead and purchased the December 450 calls, and the cost of the December calls was $14,693. I had that profit of $7,670. So my new cost basis now is $7,023. So that, again, that reduced my risk by 50% and allows me to compound my return. So that is the two parts of the high accuracy option trading. The first part, of course, we want to select the underlying stock to purchase a call option, and then part two is the trade management part of that. So let's just take a quick look at the a snapshot of my, I have two different types of retirement plans. So I have two different accounts where I trade the high accuracy option trading, and between those two accounts right now I have a $1.2 million profit and an average return of 174%. Here's the first retirement brokerage account, and this lists all the current trades that I have right now, and it lists the quantity, the number of contracts, the price I paid for the option, the last price, the current price, and then the profit, and then the percent gain. So in this account, I have a $924,000 profit and an average return of 174.4%. And here's a snapshot of my second retirement account. And in this account, I have a $296,000 open profit, average return of 174.6%. So those are my current results using the high accuracy. And what I'm going to look at now is my results over different time frames. I think if you look at the results of a strategy over different time frames, it gives you a better perspective of the profit potential of using this strategy. So the brokerage account statements I'm going to show you real quickly here. Total $1.8 million in profits, average return of 85%, and I have 183 wins, 17 losers, so about 91% accuracy. And these are, I'll just scroll through these fairly quickly just to give you an idea of how this strategy has worked in the past. In this first account, I had profits of $22,000, average return of 198%. And in this account, I had a return of 75%. Now, this is one of my contest accounts, actually, and this was a contest account, and when I took this snapshot, I had a 75% return. And this is again, this is the trading contest that if you have the highest percentage gain for the year, then of course you're in first place. So this is a real money trading contest, and all the accounts are at the sponsor's brokerage house. So this is just a snapshot of one of my contest accounts. In this account, I had a $254,000 profit, average return of 114%, and I'll just scroll through these. These total about $1.8 million in profits, and I think it's good to look at different time frames just to give you a better perspective of the strategy, and so that you realize it's not just a one-time wonder. So I'll just scroll through these quick. Okay, in this account I had $154,000 profit, 95% average return. So that concludes my presentation for today, and I can take questions. I'm going to switch over to the question portion here and see if I can see any questions that you may have. Okay, let's see here. Okay, here's a question from Don. How do you determine the option strike and the delta? And Don, we just went through the 1% rule for selecting the option strike price, and we want to limit the time value of the option to 1% or less of the stock price. And if you do that, the stock only has to go up 1%, and you're going to start profiting. Okay, well, here's a good question. What about the new 52-week low list for finding shorts? That's a good question. This is from TJ. And what I do as far as taking long trades versus short trades, I generally will take long trades when the S&P 500 index is on a buy signal according to the 50 and 100-day EMA. So if the S&P 500 50-day EMA is above the 100-day EMA, then the S&P index is on a buy signal, and then I'll generally take long trades. If the S&P 500 index drops below, if the 50-day EMA drops below the 100-day and the S&P is on a sell signal, then I start looking to take short trades. And as I mentioned previously, Prime Trade Select works for both bull and short trades. So if you're looking to take a short trade, then of course you want to see that 50-day EMA below the 100-day EMA for the stock. You want to see the on-balance volume line declining, and you want to take a look at the new 52-week low list. And as I mentioned before, we did that during the last two severe bear markets, and we were heavily short almost all the way down on those severe bear markets, and we had really good profits during those bear markets with our short positions. Okay, let's see. Okay, how do you place stop orders? And this is from Zoxy. What I like to do with the stop orders is if the option premium is if it drops 30% from my entry price on a closing basis, then I'll simply sell to close that call option. So if I buy an option for 10 points and it drops to 7 points on a closing basis, then I'll simply exit that trade, and that can help prevent large losses. That can help prevent 100% loss by using that money management. Okay, let's see what else we got here. Okay, here's a question from John. Another advantage of deep in the money is that they have a delta of 100 and no theta decay. And to be honest with you, John, I don't know what theta is. I like to keep it simple, and I like to limit that time value when I buy an option, because I know that's going to decay every day that you get closer to expiration. So I like to just keep it simple and buy an option that has a lot of intrinsic value and very little time value. And as I mentioned before, I'm more comfortable if the stock only has to go up 0.4% before I start making money with the option. So I like to keep it simple. I don't really know what the data is. Okay, let's see here. Okay, here's a question. Why don't you spread to reduce the cost basis even further? And that's from Michael, and that's a great question, Michael. What I do with my option trades is if I have a 30% profit in a call option, I'll go ahead and buy a put option to protect that profit and create a strangle. Or if the underlying stock or ETF has rich premiums, then I'll go ahead and sell a call option and create a debit spread. And if you create a spread once you have a profit in an option, then that helps protect your profits, and it can reduce your risk and increase your return. So that's a subject for another webinar. I didn't have time to go into that today, but that's a good question. We normally always create a spread once we have a profit in an option, and I can do another webinar and show you, our spread portfolios, and you can see how creating that spread protects our profits. And in the case of the strangle, it can actually lock in a profit no matter what the underlying stock does. So that's one of my favorite trades, is if I have a profit in a call option, to buy a put to protect that profit. So that's a good question, and in a future webinar we'll go into the details on the strangle spread versus a debit spread, and the advantages and disadvantages to both. Okay, here's Rob. How do you determine or scan for nice trending stocks? And Rob, the best way to do that is to look at the new 52-week high list, and if you monitor that, you'll see certain stocks start to appear on that new 52-week high list on a regular basis. So that's one of the best scans you can do. And if a stock starts to show up on that new 52-week high list on a regular basis, I'll put that on my list of potential buys, and then I wait until the stock retraces towards that middle or lower Keltner channel, and use that as a trigger to enter the trade. Okay, let's see. Let's see if there's any other. Here's a question. This is from Chaku. If it is too much in the money, if the stock goes down, you lose more. Is that right? And if I think what this question is asking is the difference between buying an in the money call and an out of the money call, and which one do you lose more money? Well, with the in the money call, you're gonna lose less if the stock goes down on a percentage basis than you would with an out of the money call. You saw those examples of out of the money calls. If the in the case of the example of Priceline, if the stock is flat or is down at all, you're going to lose 100%. Even if the stock was up 5%, you're going to lose 100%. And in the case of the in the money calls, you're going to lose a lot less. If in that one example, if the stock was flat, we were only going to lose 2% as opposed to 100%. So the in the money calls, you're going to lose less on a percentage basis than you would with an out of the money call if the stock goes down. Okay, here's a question. Do you ever trade weekly options? And I do trade weekly options, and my favorite strategy for the weekly options is weekly covered calls. And what I do is I buy the FAS, which is the leveraged financial ETF, and I buy the TNA, which is the leveraged small cap ETF, and I hold those ETFs in my account, and then each week I sell a call option against those ETF positions, and you can get anywhere from a 1.5% to a 2% premium each week by selling these covered calls and rolling them over every week. So every Friday I roll over the expiring call and sell to open the new call, and I'll do that tomorrow. And what that allows you to do over the course of a year, if you get 52 premiums and you're collecting 1.5% a week, then you could actually get more than 100% cash on cash return by doing these weekly covered calls. And if you get 100% cash on cash return, a lot can happen with that stock and you're still going to make money. You could have bad timing and when you entered, the stock could go down a lot and you could still make money. So I like to sell option premium with the weekly calls rather than buying option premium with the weekly calls. So I found that's the most advantageous way to trade these weekly options is through the weekly covered calls. Here's a question from Ben. How do you get the option calculator? And Ben, that's available. I have a total of 7 different types of option calculators for various types of spreads and call and put purchases, and they're available to the members of my advisory service. Okay, I think that's it. So I want to thank everybody for attending today, and I look forward to our next webinar when we'll discuss option spreads. And I just wanted to mention that I have a weekly newsletter, and in the weekly newsletter, it's called the Cash Cow. It's $97 for 3 months. And in the weekly newsletter, we look at various strategies, and I make recommendations for weekly call purchases, option debit spreads, option strangles, and weekly covered calls. So we have a variety of strategies we like to cover with the Cash Cow newsletter, and it's a great source for learning these various strategies. And it comes out once a week, and it's more shorter term oriented than what I have in my trading accounts, but it's a good learning tool for learning how to trade options. So we're going to show you a link that you can use to order that Cash Cow newsletter. Okay, I think that's it, Raleigh. So I want to again thank everybody for attending, and look forward to the next presentation when we'll cover option spreads. So I want everybody to have a great day today.
That's great, and thank you so much, Chuck, for that great presentation on how you use high accuracy option trading techniques to trade the options markets. I particularly found it interesting your use of Keltner channels to identify overbought and oversold signals in the market, your emphasis on trade management and in the money options, despite the fact that they may be a little bit more expensive and don't have as much leverage. I also want to thank you for the special offer you have made available to our members on the Cash Cow newsletter, and I recommend that those of you that are interested in how Chuck trades options, that you take a look at that special offer and subscribe to that very reasonable service. I also want to remind everyone that this fantastic webinar has been recorded, and we will send everyone that has registered an email tomorrow afternoon with a link to the recording so that you'll have it, and in time for this weekend, for example, if you'd like to re-listen to it and take in some of the information, advice, and techniques that Chuck has shared with us. So thank you all for joining us for this wonderful webinar with Chuck Hughes, and we look forward to seeing you at our next event. Take care and be safe, and we'll talk to you later. Bye-bye.
Bye-bye.